It's a very tragic occurrence, but I think it's just the beginning. There's about $750 trillion of derivative instruments outstanding that nobody completely understands or can get their arms around.
Translation, hundreds of billions in shaky, even fraudulent mortgages created and sold by companies like Bear Stearns. They were packaged and sold to investors as mortgage-backed securities. 6 months later, Lehman Brothers found itself in a similar situation. Barclays bought its U.S. operations, but it wasn't enough to keep global markets from going into a tailspin. Bank of America bought Merrill Lynch the same weekend Lehman filed for bankruptcy. That deal resulted in billions of losses for Bank of America and the need for government support. The rules for banks were much looser back then until 2010, when the Dodd Frank Act came into effect. That bill brought in the most significant financial regulation since the Great Depression. Earlier this week, though, the U.S. Senate passed the biggest loosening since Dodd Frank was launched. To dig into this a little bit more, we have John Coffey, professor of law at Columbia University and director of law at the school's Center for Corporate Governance Innovations. Nice to see you, sir. Could we see the same sort of calamity that we saw in 2008 again happen in today's day and age?
I don't think anything that severe is in the likelihood right now, but we are seeing that this is a country that can forget things very quickly. How soon we forget all those lessons. What we saw in 2007 and 8 was that mortgage assets, mortgage lending, which seemed very safe, wasn't. And systemic risk problems always come out of the blind side. And the blind side is ignored until it's almost too late. Now, what we did in Dodd-Frank was try to cure and curb systemic risk by saying we're going to take those banks that are too big to fail and really regulate them. What the statute that went through the Senate this week has done is to greatly relax those rules and to say that the level of too big to fail is going to be jumped from $50 billion, where it is today, to $250 billion, and leave only about a dozen banks under close supervision. That could be dangerous.
Now, the critics of Dodd-Frank, and we've heard from an awful lot of them over the course of the last 18 months or so, say that Dodd-Frank was sort of written in haste and in a time of great turmoil, and added in a bunch of things that didn't necessarily have to be there, and it's due time to update a law like that 10 years on. You call some of these provisions potentially at least dangerous. Was there a need, though, to update Dodd-Frank for today's day and age?
You know, you can always update things, but you often update on both sides. Extend it here, curb it there. This is all one way. This is relaxing all the rules. We're saying that the credit and liquidity rules required of large banks will no longer be applicable to about 90% of the banks that had been covered. We're also changing the rules on mortgage lending. Mortgage lending will be relaxed again. And sure, there's a political push for that. Frankly, everyone on both sides of the political fence likes easy money. But easy money gets dangerous quickly because relaxed lending rules and suddenly you can have a crisis and a broad collapse. And that's what we saw beginning with Bear Stearns when real estate and mortgage lending really went south.
You mentioned off the top that it sometimes feels like we've forgotten some of those lessons from 2008. I wonder, when we look at this, did we properly learn all of the lessons? Are there still things that we should be looking back and trying to glean and learn from that crisis?
Well, I think there's a serious debate on some issues. You notice that Bear Stearns was a totally different outcome than Lehman Brothers.
Right.
In the case of Bear Stearns, the Federal Reserve really strong-armed J.P. Morgan into acquiring Bear Stearns to avoid a financial crisis. 6 months later, when Lehman Brothers came along, no one was willing to intervene, and the British government really stopped Barclays from buying Lehman Brothers. And when Lehman Brothers failed, it was because the public and the politicians all said no more bailouts. But really, sometimes the central bank has to be the lender of last resort, or you get a crisis of falling dominoes. And with Lehman, all the dominoes started to fall.
You know, a lot of people back then, in sort of 2009 and 2010, when they got a sense of what had actually happened, were furious at Wall Street, were furious at investment banks, and felt that they, the individuals, had capitalized this crazy adventure that they had gone on and wanted to see real change. Do you think individual investors, the people that are putting money into mutual funds, that are their 401ks, whatever it may be, that are really capitalizing a lot of what these banks are doing, are they safer today than they were in 2008?
I think they're relatively safer, but the margin is going to start to erode if we relax most of Dodd Frank. I think what we saw then was that the investment bankers really took weak, toxic loans that no one could believe were very sound, and they securitized them. They put them into portfolios, and they sold them to mutual funds, pension funds around the globe. And that's when the crisis really spread to the world economy.
Listen, we're going to have to leave it there, but I really do appreciate making the time. It's such an important story and great to get your insight. John Coffey, professor of law at Columbia University.